Not sure when Zoom disappeared, but we were just saying, I was just saying, if we have an expense other than depreciation, so an actual cash expense like maintenance, right? Let's say our maintenance expense, just to be simple, just say our maintenance expense instead is 50K, right? That's going to reduce our taxable income just like depreciation did, so that we have 50,000 in taxable income, which means that our tax will be 20,000. So we're going to reduce, we're going to have a reduction in cost in actual expenses, because on the one hand, we're going to spend 50,000, but on the other hand, the IRS is going to say, okay, you had $50,000 less in income, so therefore we're going to cut your tax burden by $20,000. So we're going to have a maintenance expense, and then a tax savings equal to 50,000 times 0.4, right, which was 20,000, right? And so our net maintenance expense is going to be the 50,000 minus 20,000, or 30,000. Why is it 30,000? Again, we're really spending $50,000. But at the end of the year, when we go to file our taxes, the IRS will be like, we see that you spent $50,000 on maintenance. That's a legitimate expense. So you can't read my writing? Net maintenance expense. Net maintenance expense. We have maintenance expense of 50, tax savings of 20, net maintenance expense of 30. Okay, so what the IRS is going to say is, we recognize that $50,000 in maintenance expense is a legitimate expense. That therefore reduces your taxable income by $50,000. Since you're in the 40% tax bracket, that means you pay $20,000 less in taxes to us. So there's a $20,000 tax savings based on these maintenance expenses that you're not having to pay. There could be other expenses that are associated with the purchase that would not be associated with the lease. So we're really trying to isolate the things that are different. So maybe if you were buying lab equipment, for example, maybe the reagents, those are the chemicals that you put in the lab equipment to run the tests. Maybe that comes with the lease, but doesn't come with the purchase. So therefore, that would be a difference. And so we take that into account. And so we would put in reagent expenses. And if that was, $20,000, and we had a 40%, so we have reagent expenses of 20,000. We have a 40%. We're sticking with the 40% tax bracket. What would our net reagent expense be? Quick in your head, 40 times 20, right? Or 40% times 20 is 4 times 2, 8, right? Just shift around the decimals and it's 8,000. So the tax savings would be 8. And so the net reagent expense would be 20 minus 8, 12K. So if we're looking for cash flows, that would be we're looking for cash flows. It would be 12,000, not 20,000. Okay. So let's do the example that we had on the board. We're strictly talking about, we're going to start with the purchase. So we have purchase price at time 0, 1, and 2, right? So at time 0, the purchase price is how much? Or we can call it equipment. That probably ought to do. Let's call it equipment if you haven't already written down. The equipment purchase price was how much? Option 1. Lease example 1, option 1. 100,000, right? And if we're thinking about it as a cash flow, you're buying something. Is that a positive cash flow or a negative cash flow? Negative, right? Okay. Any other, and then we've got 2-year useful life. Firm uses straight line depreciation. Firm will borrow the $100,000 purchase price. We're going to ignore all right. Yeah, we're going to ignore that. Okay, we have $100,000 in equipment. And then the rest we have, we're going to ignore. You are able to ignore the loan, but we'll work that in now. So if we're going to finance this with a loan, what happens at the time that we make the purchase? Simultaneously, we're going to get what? How much cash? If you go to buy a car and you borrow the money from the bank, what happens? Simultaneously, the bank gives you, let's say your car is going to cost $100,000. The bank gives you a check for $100,000 and you hand it over to the dealer, right? So simultaneous with the purchase is the loan comes in at 100. Okay. Now, let's assume 10% borrowing cost or interest rate. Yeah, we'll call it 10% interest rate. All right. So you've bought the equipment, you've borrowed the money. Anything else happen in year 0? Based on this one, no, right? It's pretty straightforward. That's it. Now, in year 1, at the end of year 1, what are the 2 things that are going to happen? We're just focused on the costs of operating this machine. So we're not focused on, we don't care about the revenue, right? That's what I was saying, is we're just interested in cost of either buying or leasing. So if I borrowed $100,000 at 10%, what expense do I have at the end of year 1? If you borrow money to buy a car, what expense do you have? You owe interest, right? You got to pay the bank its interest. So 10% on 100,000 would be how much? 10,000, right? So we have interest expense of 10,000 in year 1 and year 2. Now, any expense that we have does what to our taxes? It reduces them, right? So if I'm in the 40% tax bracket and I have a $10,000 expense, what is my tax savings based on that expense? $4,000. I'm going to do TS for tax savings from interest. So 4,000. And I'm going to, I should have made that negative, right? So the interest expense is negative. This is money that's going to flow out. It's really flowing out. But then we have this tax savings on our interest. That's going to be kind of a rebate back. Right? What else do we have in terms of expenses of real cash effects necessarily, right? So we have what kind of expense, Brianna? A non-cash expense for what? For depreciation. So this is going to have depreciation. We said it's a 2-year straight line depreciation. So what's the depreciation expense? We already said it. 50. Now it's a what kind of expense? And we're just dealing with cash. So this one we don't have to actually write down. We don't have to write down the 50. You can. That'll make your calculations a little bit more complicated because then you'll have to add back depreciation at the end. You can just skip writing depreciation down and say tax savings from depreciation is my actual cash flow, right? So you could do it one of two ways. You could write in depreciation and then you could write in tax savings from depreciation, but you'd need to remember at the end, I've got to add back, after I get the net income, I've got to add back depreciation. I would recommend that you just get used to remembering there is no cash. Since there's no cash out for depreciation, you don't have to write it down, but you do have to write down the tax savings from depreciation. So if we've got $50,000 in depreciation, right, we said $100,000 purchase price, 2-year useful life, $50,000 per year for depreciation. What's this tax savings from $50,000 of depreciation? 40% of 50 is 20. So I can just write down here tax savings from depreciation, and it's going to be positive or negative in terms of its cash flow. The tax savings is positive, right? All right. Now, that's it. Those are all the cash flows. So we can add them up, right? So in year, at time 0, we have minus 100 plus 100. So our cash flow is, we have 10 minus 10 plus 4 plus 20. Minus 10 plus 4 is minus 6, right? And then minus 6 plus 20 is, oh, I left one out. Sorry, I left one out. We have to actually pay off the loan. Kind of an important one, right? Because at the end of the loan, we have to pay off the principal. So we have to pay off the loan. That's minus 100. So add that back in. Hopefully you got space. The loan has to be paid back at the end of year 2. So that's another 100,000. So minus 10 plus 4 is minus 6. Minus 6 plus 20 is 14. And then we have minus 10 minus 4 plus 20, that's 16. Plus 16 minus 100 is 84. sorry, 1486. Okay. You get that, right? If you borrow and you have like an interest only loan, at the end of the loan, you still have to pay back the principal. So that's what's happening there. So now we've got cash flows of 0, 14, and 86. All right. What interest rate do we use? So, of course, what are we going to do? We're going to get a present value, right? Because we need to know, we're going to want to make this comparison of this to the future, to the lease option. So we need to be able to, in order to make a comparison between two series of cash flows, we need to bring all of the cash flows back to the present. So then we need to know, in order to calculate what the present value is, we need to know what interest rate we're going to use as our discount rate. So I'm not going to get into a song and dance about it because we're low on time. You would take, because we're considering financing with debt, we'll either finance with debt or we won't finance at all, we'll lease. Since we're working with debt, we're going to use the after-tax cost of borrowing. So the after-tax or the after-tax required rate of return on the debt. You guys remember how we did that when we did the corporate cost of capital, when we were talking about for-profit companies and their cost of borrowing. What did we do to get to their actual cost of borrowing as opposed to the nominal cost, which would be 10% in this case? What did we do? Remember? So corporate cost of capital equals the weight of the debt times the required rate of return on the debt times what? 1 minus the tax rate, right? So the after-tax cost of borrowing after-tax cost of borrowing is the required rate of return on the debt times 1 minus the tax rate. So if the required rate on the debt is 10%, right? That's their actual that's the actual amount they're going to borrow at is 10%. They're at a 40% tax bracket. 1 minus 4 is 0.6. So we have 10 times 0.6. 0.6 times 10, 6 times 1 is 6, right? So the after-tax cost of borrowing is 6%. So when we discount back the cash flows for this comparison purpose, we're going to use both for the purchase version and for the lease version, we're going to use the after-tax cost of borrowing, which in this case is 6%. If I told you that the cost of the interest rate was 8% and their tax rate was 20%, what would their after-tax be? $6.4, right? So before tax was 8 times 1 minus 0.2 equals 8. 1 minus 0.2 is 0.8. So 8 times 8 is 64. Move the decimal one, 6.4%. Okay. But we're going to use 6 because that's what we're using in this example. So the reason we're going to use 6%, not 10%, is because 6% is going to be our discount rate. Because the effective borrowing cost, or the after-tax borrowing cost, the effective borrowing cost is 6%. 10% times 1 minus the tax rate. All right. So what are these cash flows worth? Well, we're gonna bring this one back at 6%, this one back at 6%. So I'm going to take, if I do this manually, I'm going to do 14,000 divided by what? So this first cash flow is 1 year out. My discount rate is 6%. What am I going to do? So my present value equals my future value divided by 1 plus I to the n, right? So I've got 14,000 as my future value because it's 1 year out, divided by 1 plus the discount rate, 1.06, and it's 1 year out, so it's raised to the first power, which is, we don't need to write down, right? So it's 14,000 divided by 1.06. 13,207. So let's say, yeah, 13,207. Then I have, oh, and this is minus. Then I have minus 86,000 divided by 1.06 raised to the second power. So 1.06 times 1.06. Yeah. All right. 1.06, and we'll just do squared. And then I'm going to invert it times 86,000, and it's negative, gives me 76,540. So I can add to this the 13,206, and I get a PV equal to minus 63,334. Right, so I've brought everything back to the present. The 14,000 positive cash flow that I have in year one. And then I brought back from year two the negative 86,000 for a present value of negative 63,334. Remember, we're not talking about a project, we're talking about a cost. So it's perfectly reasonable for it to be negative. You're going to expect these answers to be negative because you're paying for something and you're just focused on what you're paying for. So what we're really trying to look for, what we're looking for is a low cost option. All right, does everybody follow what I did? Let's review real quick. I bought the equipment at year one, at time zero for $100,000. I took out a loan simultaneously to cover the cost of the purchase. So that nets out to zero. So at time zero, I brought $100,000 in and I immediately turned around and sent it back out again, right? So the net cost at time zero to us is nothing. At the end of year one, I had to pay 10% interest. It's cash only balloon payment. So I'm just going to pay interest. So 10% interest on my $100,000 loan is $10,000. But because it's an expense, that reduces my tax burden by 40% of whatever the tax is in this case. So whatever the tax rate is times the expense. So in this case, 40% of 10,000 savings is a positive back into me because it's reducing my taxes at the end of the year. So yes, I really sent the bank $10,000. It's a real cash expense, but then I really reduced my tax burden by $4,000. So that's a real positive cash flow, right? Then we said, oh, we also have depreciation. This is a 2-year life, useful life piece of equipment, straight line depreciation. I'm only interested in cash flows, and Brianna, depreciation is a non-cash expense. It's a non-cash expense. Say it like you mean it. Hold your fist up when you say it. It's a non-cash expense, right? So you're going to say, all right. So that means that I don't have to write down the actual $50,000 in expenses because we're focused on cash flows here. But I do get to take a tax savings on the depreciation. So just like my interest expense, the tax savings on depreciation is the tax rate times the depreciation expense. 40% times 50 gives us that 20,000. Tax savings is always positive, right? Because it's reducing our taxes. So then we net out for year one, we have the real cash going out to pay the bank for the interest. We have the real tax reduction of $4,000 because of the interest. And then we have the real reduction in taxes for our depreciation. So that's year one. That nets out to 14,000. In year two, we have the same stuff for the first three lines. We really pay $10,000 in interest. We really save $4,000 in tax. We really have a $4,000 tax savings as a result of having paid the interest. And then we really have $20,000 in tax savings from our depreciation. So that's all the same as year one. But then at the end of year two, we close out our loan by paying the bank back. We write the bank a check for $100,000. That's a real cost. That's real cash going back to the bank, right? That gives us our net. We then take we discount those cash flows year one and year two back to the present, using the after tax or after tax interest expense, right? By taking the interest rate, the real interest rate, times 1 minus the tax rate. That gives us our effective discount rate, and we use that discount rate to discount back to the present. Now, here's the thing. Let's look at, for a second, the loan by itself, the interest expense, and the tax savings from interest, and then the payment of principal. If we extract that from this operation, so at time 0, we really borrow 100,000. At times 1 and 2, at time 1, we really have 10,000 in interest expense. We really have 4,000 in tax savings. Year 2, we really have 4,000 in tax savings, and then we pay the principal back, 100. If we net all this out, we have 100, 6, and that's negative, minus 10, minus 6, minus 10 plus 4 is minus 6. Minus 6 plus minus 100 is minus 106. If we do the present value for each of these now, to bring them all back to the present to see what the total effect of the loan is on our calculations, 6,000 divided by 1.06, right? 1 plus the discount rate, 106 squared, 106,000 divided by 1.06 squared. All right, so 6,000 divided by 1.06 gives us 5660. So negative, right? And then $1.06 squared inverted times 106 gives me 94, 340 negative. If I net that together, what do I get? If I add this up. So I have 100,000 minus 5660 minus 94, 340. Right, does everybody follow what I just did here? We're just focusing on the financing portion of our purchase. I borrow 100,000 at time zero. We have our interest payment and then our tax savings from our interest in year one. That gives us a net of -6. So we've got plus 100 at time zero, net of -6 at time one. And then at time two, we pay our 10,000 in interest. We get 4,000 in tax savings. So that nets out to 6,000. But then we have to pay off the loan at the end of the 2 years. So we also pay off the loan minus 100. That gives us 100,000 at time zero, negative 6,000 at time one, negative 106 at time two. If I discount these two back to the present and add it all up to get my total present value of the purchase, there's no effect. So what I'm taking 20 minutes to show you is when you do the calculations for the purchase, you can just leave out the financing section, which makes this particular calculation super simple. So going back to our calculations, what could I have done? Well, if I leave out the financing portions of our calculation, I could drop this, I could drop this, and I could drop this, and I could drop this. Right? So if I'm leaving out the financing for this particular calculation, I would have the equipment purchase price at time zero of 100,000. And then the only other expense that I'm dealing with is depreciation. And that, because depreciation is what kind of expense, Brianna? Thank you. That's just going to generate a tax savings from depreciation. We said that was 20. Right? Then we could just net this out. Right? Minus 100 plus 0 is minus 100. 20,000 and 20,000. So now we do the present value. Well, we've got minus 100. We bring the 20,000 back at how much? Same as before, 6%, right? So 20,000 divided by 1.06 is 18,868. And then 20,000 again now divided by 1.06 squared. Right? 1.06 squared invert times 20,000 gives me 17,800. Now, if I net that up, so plus 18,868 minus 100 gives me 63,332 negative, which is $2 off because of rounding from our initial calculation. So what I'm trying to show you is, I told you you could drop the financing section, and I'm showing you after we drop the financing section that we get the same result. Because the financing itself, if you're borrowing and then discounting back at the same rate as your financing, right, you wind up with no effect. So by having dropped the financing section, I get the same result. Now, you're saying, well, I was paying $10,000 in interest. What was my true net interest payment at year one? I paid 10, but I saved 4. So what did I really pay net on interest net? Paid 10, but saved 4. My net interest payment is 6, right? And what is 6 with respect to 100? It's 6%. So it matches up to our discount rate, which is why that nets out to 0. All right. So what I'm telling you is you don't have to write in the loan and then pay it back. You don't have to deal with the interest and the interest savings. You can just ignore all of that. Now, let's compare that. We're still doing the same scenario 1, or at least example 1. And we said that the other option, so this is the purchase option. The other option is the firm leases the equipment for $55,000 per year for 2 years. Lease is payable at the beginning of the year. How many of you guys are renting a house right now or renting an apartment? Yeah. Just what? Yes. Okay. So a bunch of you are. All right. Does your landlord expect to be paid at the beginning of the month or the end of the month? Beginning, right? So on May 1st, you probably cut a check to your landlord and said, here you go, right? Or Venmo'd them or whatever they take. Similarly, if you're going to lease a piece of equipment, you're typically going to pay it at the beginning of the year, not the end of the year. So in this case, we're going to have a lease payment at time 0 of 55 for year 1. And then at the beginning of year 1, we're going to have another lease payment of 55 for year 2. And what are we going to pay at the beginning of year 2? So let's think about this. You rent your house in January. You make your first payment in January. You make your last payment on the 1st of December. I'm asking you, what do you owe your landlord on December 31st? Nothing, right? Because you're moving out. So same thing with this. If it's a 2-year project, you're going to have 2 lease payments. The first one is due at the beginning of year 1 for year 1, right? So if I pay here for year 1, and then I pay at the beginning of year 1, at the end of year 1, beginning of year 2 for this year. And there's nothing at 2. So a lot of folks will get wound up and they'll be like, oh, and then there's another payment here. No, there's no payment because you already paid for that year, right? Now, it's a lease expense, right? It's a lease payment. So if it's an expense, that means we have a what? What's the effect on our taxes? We're going to have a tax savings from the lease expense, right? Just like we had from maintenance expense, just like we have from depreciation, right? And this is, or interest. So we're going to have a tax savings from lease. And this is negative, I should have said, right? So tax savings from lease, if it's a 40% tax bracket, 0.4 times 55 is 22. 22 and nothing. So our cash flow is 55 minus 22 minus 33 and minus 33. Okay. Sorry, that shouldn't be minus. That's a plus because it's a tax savings. So we spend 55 at time 0 and time 1. At time 0 for year 1. At the end of time 1 for year 2. Right. We have tax savings in times 0 of 22,000, and at the end of year 1, tax savings of 22,000 again. So our cash flows in each year are minus 33. What is the present value? I've got to bring, what do I got to do with the 33 at time 0? Nothing. It's already in the present, right? It's already at time 0. So I'm going to bring this one back at 1.06. So 33,000 negative divided by 1.06 is 31,132. It's 31,132. So 33 plus 33 is 64,132. Negative 64,132. So the real cost of leasing is going to be $64,132, right? That's our cost. It's negative. So it's expense. And we were expecting that. We're not dealing with any revenues here. It's all expense. So now the question is, which would you rather do? Would you rather buy the equipment or would you rather lease the equipment? Yes, why? It's cheaper. Yeah, that's a simple explanation, right? It's going to cost me 63,000 to buy the equipment and right, or it's going to cost me 64,000 to lease the equipment. I want to pay less. Less is better when it comes to an expense. Now, there's a concept called the net advantage to leasing. Or NAL. And the NAL is calculated as the net NAL is equal to the PV of the lease option minus the PV of purchase option. Right? So the net advantage to leasing. So the PV of the lease option is 64,132 minus 63,332. So I have 64,132 minus 63,332, and it's a negative. So what does that give me? Ah, shit. I did something. Oh, I didn't make the 64,132 negative minus 63,332 minus gives me $800. So NAL is the NAL is the present value of the lease option minus the present value of the purchase option, right? So I'm subtracting a negative number from a negative number. That's the same thing as adding. So this makes this positive. So 64 plus minus 64 plus 63 gives me minus 800. So is there a net advantage from leasing? And the answer is no, it's negative. Now you intuited that just by looking at which one's got the bigger cost. Got all this worked out in the spreadsheet that I gave you guys, so you can reference that. All right, I'm going to jump into the next one. So now we're going to do lease example 2. We'll start with the purchase option. We're going to still use 10% as our borrowing. We're going to have a 4-year project. Option 1 is to purchase. So the equipment is going to cost us $200,000 at time 0. Then we have 1, 2, 3, 4. And then we say we've got and we're with the purchase now, what we showed what I took a while to show you was we don't have to actually show the financing portion. If we were going to, we would then say loan of 200,000, interest expense 10% of 200,000 would be 20,000. In tax savings from interest would be 40% of 20,000 would be 8,000. So on. We're going to ignore all the financing of this discussion. Now, it says you've got a maintenance contract that starts at the time of purchase for $2,500 a year. So we'll have a maintenance expense of $2,500. And that's an expense, so it's negative. But if I've got an expense with this calculation, what else do I have? Anytime I have an expense, I'm going to have a tax savings, right? So we're still playing in the 40% tax bracket. So just stick with that. So we'll have a tax savings from maintenance of 40% of 2,500 is 1,000. Okay. And then we have the equipment has a 5-year life, and we're going to use the maker's schedule. So there's no more expenses at time 0. So we can move on to time 1. We're going to have a maintenance expense in time so we had a maintenance expense for year 1 at time 0. We're going to have a maintenance expense at time 1 for 2, time 2 for 3, time 3 for 4, and then nothing in year 4 because that would be for after the project was over. Then we will have a corresponding tax savings with each. Okay. Now, what else do we have? Well, the equipment has a 5-year tax life. So what kind of expense do we have, Brianna? Non-cash depreciation expense, right? So we're not going to do the depreciation, the actual depreciation on here, but we need to figure out what is the tax savings from depreciation. So we need to know, this one gets a little funky. So let's, we've got our schedule here. So in year 1, we're going to take 20% of our purchase price. So that's going to be 40. But we're going to take 40% of 40. So we have depreciation expense of 20% of 200,000. So that's 40,000. 20% of 200,000, excuse me. Yeah, 20% of 200,000 is 40,000 times 0.4, 40%. So we're going to have 16,000. And that's a positive, 16,000. Am I hearing a what? What? All right. Yes. So I have equipment of 200,000. In year 1, I get to take 20%. You've got your maker schedule over there at your desk, right? So I'm going to take 20% in year 1. That's $40,000 in depreciation. My tax savings is going to be 40% of 40,000. That's 16,000. In year 2, I'm going to take 32%. So 0.32 times 200,000 is 6,400. 0.32 times 200,000 is 64,000. So still 200,000 times 32% gives me 64,000 in depreciation. That translates into a depreciation expense of times 0.4, 25,600. In year 3, I take 19.2%. 0.192 times 200 gives me 38,400. That turns into a 15,360 tax expense, tax savings. And then in year 4, which is my last operational year, I get 11.52%. So 0.1152 times 200,000 gives me 23,040 times 0.4 gives me 9216 in tax savings. So those are all my tax savings. So now I'm going to program those in. So I get 16 in year one, 25,600 in year two, 15,360 in year three, and 9216 in year four for tax savings from depreciation. I have a salvage value in this problem of 20,000. I'm going to sell the equipment for $20,000 at the end of year four. But what do we know about salvage? Right? We got to pay taxes, or we either have a tax savings or a tax gain. So we purchase. So this is all the depreciation we've taken. So we took 200,000 minus 40,000 minus 64,000 minus 38,400 minus 23,040 gives us 34,560. So our book value, what I just did was I took the purchase price minus the accumulated depreciation. So our book value is 34,560. 34,560 is what the IRS says it's worth. We're getting $20,000 in sale price. So we have a loss of 14,560, which means that we have a tax savings. 14,560 times 0.4, right, is 5824. So we have a tax savings because the IRS says we have a loss. We have a tax savings of 5824. So tax savings on salvage, 5824. That's it. So now we can net this up. So cash flow in year zero, we get 200 minus 200 minus 2,500 plus 1,000. That's 201,500. Net for each of these is, I'm not going to take the time to talk it through, 14,500, 24,100, 13,860, and adding all that up, 35,040. In this case, I would use the cash flow register. You're going to use a discount rate of 6% again. I'm just going to tell you the punchline. The PV of the cash flows is 126,980 negative, right? So we'll stop that one. And now we're going to talk about leasing, the lease option. The lease option is a little bit simpler. You have a lease expense. And we said that the lease expense is going to be $50,000 per year due at the beginning of each year. So we got 0, 1, 2, 3, 4. So we'll have 57, 57, 57, 57, and then nothing, right? I'm dropping the zeros just to save my time. Whenever I have an expense, I have an associated tax savings. So I have the tax savings from, and these are all negative. I have an associated tax savings from the lease, and that's going to be 40% of 57 of 57. That's 22.8, 22.8, 22.8, and 22.8. Our net cash flow then is 34.2, 34.2 negative. Right. Then we just simply have to bring all of these three back to the present, and we get the present value of the cash flow is equal to 125,617. So when we can now we can do the net advantage to leasing. So we take the net advantage to leasing is minus 125,617 minus the the present value of the purchase price, 126,980. So 125,617 negative minus 126,980 negative gives me 1363. So in this case, would I rather buy or lease? Lease, because I have a positive net advantage to leasing. Or you could just intuitively look at it and say, the present value with the lease is negative 125. The present value with the purchase is negative 126. All right, that's it.